Hey guys, my name is Evan and welcome to Evanomics 101, your number one source for everything econ. So inflation just delivered one of the biggest surprises for 2026. The June CPI report came in much cooler than a lot of economists expected, with consumer prices actually falling on a monthly basis and annual inflation slowing to around 3.5%. The big question though is this a real inflation slowdown or is it just a temporary drop caused by falling energy prices? Because the answer could determine what the Federal Reserve does next, and it could impact stocks, bonds, interest rates, and your wallet. Today, we're going to break down the June 2026 CPI report and what it really means. So, in today's video, we're going to cover the actual CPI numbers and what drove inflation lower in June. We're going to cover the hidden details behind the report, including energy, core inflation, and whether inflation is truly cooling and what this means for the Federal Reserve, financial markets, and consumers moving forward. Before we jump into the video, I do have a quick favor that really helps grow the channel. If you enjoy simple breakdowns, please hit the like button, subscribe to Economics 101. You won't miss a video in the future. So let's go ahead and jump into the CPI numbers. So the headline from the June CPI report is pretty simple. Inflation moved lower. According to the Bureau of Labor Statistics, the consumer price index for all urban consumers decreased 0.4% in June on a seasonal adjusted basis. Over the last 12 months, price increased 3.5%. The monthly decline was significant because it represented the largest 1 month decrease since April 2020. Now, when people hear inflation fell, they sometimes assume prices are going to go pretty much everywhere. That is not actually what happens. What CPI inflation slowing means prices are increasing just at a slower pace. So I'm gonna give you an example. If your grocery bill went from $100 to $110 last year, inflation was 10%. If this year it rises from 110 to 113, inflation has slowed, but prices are still higher. That distinction matters because consumers are still feeling the impact of years of higher prices. But the direction of inflation is what policymakers care about the most. And in June, the direction improved. So the next question becomes what caused the improvement? The biggest reason inflation cooled down was because of energy. And we know this. We kind of saw a little bit at the pumps. So the energy index dropped 5.7% during the month, making it the largest contributor to overall CPI decline. Gasoline prices played a major role. When energy prices fall, it affects more than just what's at the gas pump. Lower fuel costs can reduce transportation expenses, shipping costs, and some businesses that can eventually enter prices across the economy. But here is where investors need to be careful. Energy prices can move quickly. Oil prices can rise because of geopolitical events, supply disruptions, or changes in global demand. So while lower energy prices helped the June CPI report, the Fed will want to know, is inflation cooling underneath the surface? That brings us to one of the most important parts of the report, and that's core inflation. So headline CPI gets a lot of attention, but the Federal Reserve pays very close attention to core inflation because it removes food and energy, two categories that are extremely volatile. All right. Core CPI showed a much more moderate improvement. The core index was unchanged on a monthly basis and increased about 2.6% over the last year. So why does this matter? And the reason why is because the Fed is trying to determine whether inflation is actually becoming more stable. A 1 month drop caused by gasoline prices is helpful, but policymakers want to see improvement across services, housing, wages, and other categories. The good news is that inflation pressures appear to be moving closer toward the Fed's long-term goal. The challenge is that inflation is still above the central bank's target of 2%. And that leads directly into the biggest question that investors have. What will the Federal Reserve do next? On one side, has been to immediately declare a victory on the inflation fight. On the other side, keeping the interest rates elevated for too long risks slowing economic growth. Okay. And midterms. This CPI report gives the Fed a stronger argument that inflation is moving in the right direction. Lower inflation could create more room for the future rate cuts. Um, And rate cuts because they influence a lot of things across our economy. Rates, bond market, consumer. When interest rates fall, companies often benefit because financing becomes a lot cheaper. They're able to borrow at a lower cost. Investors also tend to value future earnings more highly when borrowing costs decline. However, the Fed will not make decisions based on one CPI report alone. They will also watch employment data, economic growth, wage trends, and future inflation reports. So the market is not simply fail, therefore let's go ahead and cut rates. It's a little more complicated than that. The Fed wants confidence that inflation is under control before making major policy shifts. And that brings us to the final piece. What does this mean for regular people and regular investors? We got a quick pause, guys. If you want more breakdowns like this, then make sure you subscribe to Economics 101. Every week, we break down inflation, interest rates, markets, and the biggest economic stories in the way makes sense. If this video is helping you understand the economy a little bit better, please hit the like button because it helps more people find the channel. All right. Now let's talk about the real world impact for people like yourself and for me. Okay. So for inflation is good news. A slower inflation rate means households may see less pressure from rising prices. But remember, lower inflation does not mean prices return to where they were years ago. The price level remains much higher than before the inflation surge. For investors, the CPI report could influence expectations around interest rates. Lower inflation can support things like stocks, bonds, rate sensitive stocks like housing, and markets will continue watching whether this trend continues. The biggest takeaway is that inflation is moving in the right direction, but the journey is not finished. The economy is still balancing three major forces. That's inflation, that's interest rate, and that's growth. Okay? The Fed wants lower without causing unnecessary damage to employment and economic activity. That is why every CPI report that we get, it matters. It gives investors another clue about the economy, where the economy is heading. So, what is the takeaway from the June 2026 CPI report? The big takeaway is that inflation cooled. Energy prices helped push prices a little lower, core inflation improved, and the Federal Reserve now has more evidence that inflation pressures are easing, that they're getting it under control. But the next few inflation reports will determine whether this is a real trend or simply a temporary improvement. Now I want to hear from you. Do you think the Fed should start cutting interest rates after this CPI report, or should they wait for more data? Let me know what your thoughts are in the comments. If you enjoyed this economic breakdown, make sure to like the video, subscribe to Economics 101, and share this with someone who wants to better understand the economy. This is Economics 101, your number one source for everything econ.